Good morning, good afternoon, and good evening. My name is Trang, and I'm delighted to be your host for today's Refinitiv Perspectives livestream. The London Interbank Offered Rate, commonly known as LIBOR, is the measure of the average rate at which banks are willing to borrow wholesale unsecured funds. LIBOR essentially determines the cost of borrowing around the world, from student loans to mortgages to interest rate swaps or collateralized loan obligations, underpinning $300 trillion worth of financial contracts. LIBOR is also used as a gauge for market expectation regarding central bank interest rates, liquidity premiums in money markets, and during times of crisis as an indicator of the overarching health of the banking system. Changes in the underlying funding models for banks have, however, reduced liquidity in interbank lending markets and exposed the vulnerabilities of LIBOR. As markets evolved, the trading that underpinned these estimates have dried up. In the wake of the 2008 financial crisis, regulators had also discovered that the banks trusted to set the rates for hundreds of trillions dollars worth of financial assets had actually manipulated them to their own advantage. As a result, in 2017, the UK's Financial Conduct Authority has made an unprecedented announcement telling banks to actually no longer contribute to LIBOR post-2021 and instead encourage them to transition to alternative risk-free rates. So today we'll be discussing what has happened since and what banks need to be aware of when it comes to the LIBOR transition. And it's my greatest pleasure to introduce our two guests for today, Rebecca Weinrauch, Head of Fixed Income at ASIFMA, and Philippe Shah, Head of Benchmarks and Indices APAC for Refinitiv. Welcome both.
Thank you.
Thanks for joining us today. And I guess just to kickstart our conversation, I've touched on it in my intro a little bit, but Phil, can you perhaps explain what LIBOR is and what are some of the problems associated with it?
Yes, absolutely. And hi, everyone. So as you mentioned, LIBOR has been around for a very long time, and it is, as it says on the tin, Interbank Offered Rate. So what it is, it's a highly utilized benchmark, which is used ubiquitously. It's in many, many places, but it's really based on indications and basically a poll between a number of banks who are basically submitting to the benchmark administrator and calculating agent rates that they would be willing to lend to another bank. So unlike a lot of other benchmarks, indices and things like that, which are based on actual transaction data, it's based on an indication or on a submission or on a poll. And that is obviously seen as less robust. You did touch on some of the sort of history of LIBOR. There's been a lot of news around it in the past, which was down to manipulation and behavior of the panel banks on LIBOR. And that was the sort of first issue which came around, saying, well, these kind of benchmarks are quite easy they could be prone to manipulation. But that was really something that I think was solved once there was a lot more focus on governance and codes of conduct and really best practices to make sure the panel banks basically submitted rates which were really genuine and they were actually prepared to use. But what happened after that was there was just a realization that LIBOR was really based on a market or trying to measure a market which was just not really as relevant as it used to be, basically after the financial crisis. So they were saying, well, it doesn't matter how much we fix this thing, the fundamental issue is just the market it measures just doesn't really exist much. So it doesn't matter how much governance and robust codes of conduct and all those things we can do, there's still a problem there. There's just not much of a market anymore, and funding has changed. And that's an issue with LIBOR, but also there's a lot of other similar benchmarks around the world. Every country has its own version of LIBOR, which is an interest rate benchmark where the same kind of concept of panels of banks submit rates to an administrator and a rate is published, and they all suffer more or less from the same issues. And obviously, LIBOR is the biggest one. It's available in multiple currencies, all of the sort of biggest global currencies, and that's the one where a lot of the attention is focused on. But that has driven, a lot of other countries and regions to look at the issue themselves too.
Rebecca, do you want to add to Phil's?
I would just add that the interesting thing about LIBOR is that nobody thinks about it, but most financial products are priced off it. So even if you're an oil trader, or you're trading gold, or you're trading, who knows, I'm sure there's LIBOR related Bitcoin. Like, a lot of things are priced off LIBOR. So even if you think, oh, I don't do derivatives, I don't have a bond priced in LIBOR, oh, my loan documentation is good, it extends beyond that, and it's got a really broad reach. And a lot of things will have to change in how they're calculated because of this transition.
Okay, thank you. And for those who are unfamiliar with the whole transition process, can you maybe, Phil, explain what is the LIBOR transition in a nutshell?
Yeah, so I think it's clear that LIBOR really is everywhere. For so many different financial and also some non-financial institutions, it's all over the place. It's sort of hardwired into so much kind of plumbing and sort of systems in many banks and let's say corporates, asset managers, pension funds, so on. And this thing has never changed. It's not really changed in so many years. And this kind of deadline, which has been enforced by the FCA, really means that there's a big change that a lot of the sort of users of LIBOR need to make, and that's why there's this whole sort of LIBOR transition process. And I guess we'll get into that now, but basically what they need to change from is something very different from what from LIBOR is. Which really will take a lot of time. So there's a lot of things that banks need to do. Firstly, before anything, they need to look at where is LIBOR and all these other similar related instruments. If you're a huge bank with offices everywhere and all kinds of different systems, that exercise alone of figuring out where this thing is can take many, many months before then you decide, well, what is my plan to move off it? Is there a format? Is there a sort of industry standard way of moving off it? And it all depends on different use cases, different exposures. So this obviously is very complex, and that's why we have this kind of massive topic, which is LIBOR transition. That's why, in a position such as ourselves at Refinitiv, where we have such a sort of massive scope of clients, we're getting questions which are all sort of very, very different from different segments all around LIBOR transition, because there's a lot of work to do, and still, there's a kind of date when we think LIBOR is going away, but it's not. The added complexity, it's not like a sunset date. It's not like when you have a legacy IT system which is being switched off on 31st of December 2021. There will be a date at some point where LIBOR ceases to be representative, but it's not a kind of set in stone date. We more or less know when it is. Everyone is kind of aiming towards it, but there's a few other. It's slightly different. And depending on your interpretations, some people and some institutions may choose to act a bit quicker than others around this transition.
Any thoughts to add, Rebecca?
I think that really covered it. I mean, I would add that if the large institutions choose not to support IBOR, and at some point it's going to be difficult for them to do that, it will cease to exist. So it's not like there's one lone player that can sort of hang out there and keep putting on pricing. It's not going to work that way. So once there's no critical mass, it's just going to kind of disappear. And it's important to remember that, because these financial institutions aren't going to be concerned about corner cases unless they materially impact them.
Phil, you mentioned that there is no set in stone deadline for the discontinuation of LIBOR. And I think when I was researching for this episode, like what has come up a lot is the COVID-19 impact. And I was wondering, we don't know when is the sunset date, but Rebecca, do you think COVID-19 has impacted this transition process? Did it cause any delays? What is the impact?
Well, there's two answers to that, I'm afraid. The first is the practical answer, and the practical answer is yes, absolutely, it has. here in Asia, as everyone is experiencing globally, there's a lot of important things to think about. And, perhaps IBOR transition took a second seat to sort of the crisis that people were facing in banks on a daily basis as COVID intensified and became front and center of really what people were dealing with. The second answer is theoretical, and that is no, it hasn't. The expectation that the transition will continue apace is very much there. And even economies that are hard hit by COVID will still have to be IBOR ready. We at ASIFMA had Madam Bandia Dimple on speaking from RBI a couple weeks ago on a webinar, and she was very plain. Like she said, look, India's in crisis. We're really struggling. The last thing we want to think about is IBOR transition, but guess what? Too bad we have to. This is very much a problem we have to face today. So practically it has, but in terms of the expectation of regulators to get it done, no.
Phil, do you agree?
Yes, absolutely. I mean, I think the message from the regulators and especially the FCA and the other sort of big hitters, absolutely. I mean, the sort of the deadline of when they're saying to everyone to be prepared for the end of LIBOR certainly hasn't changed. And when they've been pushed on that due to COVID and that, they've certainly not, changed their mind, and the message is the same. There's been a few kind of shifting of some of the kind of milestones that certain banks and certain jurisdictions need to complete before then. But the big picture is exactly, it's the same message. But I think, we will see in terms of readiness and so on, I think we've certainly seen the big global banks throwing a lot of people at this, we've got a lot of project managers, a lot, entire teams to look after this issue. And I think, that they also read that message loud and clear. I think what's interesting is some of the smaller institutions, especially here in Asia. I think, there's been certain forums where some markets are voicing concern, maybe in sort of corporate segments, for example, especially in industries which obviously have quite a lot of problems now. I think there's been concerns voiced and wanting potential extensions, but I think the message is always, don't count on it, and this needs to be done.
Okay. And I guess central banks around the world are also designating alternative risk-free rates, and there's actually a whole host of them. So if you had to break it down, what are the pros and cons of these different alternative benchmarks, Phil?
Yeah, so basically, in a nutshell, LIBOR is a kind of hypothetical forward-looking rate where banks will say, in anything up to overnight, up to 1 month in advance, 1 month looking forward, how much they'd be willing to lend to another bank. So today, I would know what the LIBOR rate is going to be, or what the lending rate is going to be 6 months or 1 year in advance. So all these IBORs are what's called forward-looking by design. And what the main regulators and central banks have decided is to move to these risk-free rates, which are not based on a panel of banks submitting rates. They're based on actual transactions, on actual data. So that could be deposits or repo, which are basically confirmed trades, usually to a central bank on an overnight basis. So obviously that's much more robust, which is a great thing, because it's a much more kind of less. Well, there's no manipulation possible because it's actual transactions, and you can't argue with that. There's also plenty of data in these markets. You don't need to worry about the fact that there's not so many banks lending to other banks. There's a lot of liquidity in those repo and deposit markets. But basically, these new benchmarks are all going to be they're all based on kind of historical data. So to get your equivalent of 3-month LIBOR or 6-month LIBOR, you basically have to average the previous months of all this transaction data. So to put it simply, you've got one benchmark which is forward-looking. You know exactly what you're going to get to, for 6 months from today if you've got like a mortgage or something like that, or a loan. Whereas everything based on these risk-free rates is based on historical data. It's just calculated a completely different way. And with the LIBOR panel banks, when they were doing their submissions, there's obviously amount of credit risk, which is taken into account when they give those submissions. So that means you get a slightly different rate than if there's no risk at all. So the rates themselves can be a bit different, different credit profile. You can also get different levels of volatility. LIBOR, due to its panel nature, is less volatile than these risk-free rates, which are always based on overnight data, and they're just kind of a lot more spiky. So basically, it just means you've got two very different animals. You've got LIBORs and LIBOR and other IBORs, and you've got these risk-free rates. And the massive challenge for these banks and so on is really you've got all these systems which are using LIBOR. Some of these systems have been built just years ago by people who often aren't in these banks anymore or other institutions, and no one really knows how to fix them. And basically, all these calculation methodologies need to go from being forward-looking to historical, which is a very, very complex task. So that's basically what you have. Rather than forward-looking rates for your 3-month LIBOR, it's all based on whatever the risk-free rate is for that currency. In the UK, it's SONIA. In US dollar, it's SOFR, and there's more and more of these which are emerging.
Rebecca, what are your thoughts on risk-free rates?
Okay, I mean, it's a complicated process. We're at ASIFMA, we're working with regulators around the region to help sort of them define and share with the market, including those people who take exposure in their markets, outside of their markets, how to handle the risk-free rates. But this transition is going to have winners and losers as people sit down and figure out their transactions. And because the rates are forward-looking, you know, that makes it difficult to see who these are going to be right now and how that's going to be handled. So, you know, the fact that the rates aren't today readily understandable because they're forward-looking adds a layer of complexity.
Okay, thank you. And I guess there's so much focus on the risk-free rates. Are there any alternatives to replace LIBOR besides these rates?
Yeah, so I think that's interesting, and I think the first thing I'd mention is that whilst LIBOR is going away, there's a lot of other jurisdictions where their equivalent is not going away, not at least for the short or medium term. So we've got a lot of benchmarks here in Asia where they've really said our IBORs are going to be around for quite a while. So that is basically some central banks and regulators and working groups really acknowledging that there are some segments of the market where it could be quite complex to switch from this forward-looking LIBOR concept to something backward-looking. It may just be a lot of work for them to handle. So in some markets, like we've seen in Hong Kong, HIBOR, JB8 HIBOR, BBSW in Australia, SIBOR in Singapore, at least for the next few years, they're not really going anywhere, because I think there's some more, there's some markets, like especially with loans, where you really need to have that sort of forward-looking cash flow certainty. So that especially in Asia, there's quite a lot of these IBORs which are staying. But what we're also seeing in other jurisdictions like the UK, US, Japan, and Eurozone is there's new term benchmarks which are coming out, which are based on these risk-free rates, but they are also going to be forward-looking. And those are going to be based on the new market data, which is becoming available, and more liquidity pools growing as more and more people start moving off LIBOR and start using risk-free rates. So as more people move off LIBOR onto SONIA, which is the UK risk-free rate, there will be more SONIA derivatives available, more SONIA overnight index swaps, more SONIA exchange futures, and more liquidity. Same in the US, same in Eurozone, same in Japan. So in those jurisdictions, there are efforts to make new forward-looking benchmarks based on this new RFR-related transaction data. So it's still very kind of robust and based on actual transactions, but it will give the users a predetermined forward-looking rate. So actually, Refinitiv, we're doing that in, we've launched our term SONIA reference rates. In Japan, there's Quick, which has already launched their ones. And then in the US and Eurozone, there's going to be a process where the regulators and related working groups will also decide on one to use. And the idea, but I need to stress there that these forward-looking rates are really intended for the less sophisticated kind of LIBOR users, which is typically in the cash markets, such as loans and so on. For derivative markets, which is a huge segment of most of the LIBOR usage, the message is loud and clear. They're just supposed to use these risk-free rates by using all the historical data, doing all the compounding, and basically doing all that heavy lifting I was talking about, and incorporating these new sort of calculation methodologies. So there will be these term rates, and I think we started with the most developed markets simply because they're the most liquid. There's other jurisdictions which have said they're looking into these rates. So say, for example, in Singapore, in Thailand, there is one in India already, but they all suffer from lack of liquidity because the OIS markets and the interest rate futures markets are just very, very limited, and they're not liquid enough to create a reliable rate. But I think what we will see is, as people move off LIBOR, and rather than these kind of IBOR benchmarks, we'll see a few of them still exist for a while, but there'll be a huge amount of focus on all these risk-free rates. And I think we'll see more of these term versions of the risk-free rates, which gradually in more and more markets get adopted also.
Thank you, Phil. Rebecca, anything you would like to add to Phil's answer?
Oh, I think Phil's answer was incredibly comprehensive.
Yep. And I'm just also looking at some of the questions from the audience, and I think one is also related to, I guess, your answer, Phil, around alternative benchmarks. And I guess the question is, most of the alternative rebates are overnight. How to manage term structure?
Yeah. So I think that goes back to, again, for derivative markets, there are, because everyone is being told to move to the risk-free rates, there are kind of starting to emerge some kind of common conventions to do this. So the problem with compounding and using all this historical data, it sounds fairly simple, but the problem is you have holiday dates and accounting conventions and things like that are very different in all kinds of different countries. What's important is to get consistent and well accepted compounding methodologies. So basically, when everyone is looking at this historical data to replace where they had their forward-looking LIBOR exposure, if everyone used a different methodology, it's going to be very, very messy and disruptive. So what we're seeing is, if you look, for example, in the UK, the Bank of England, as well as publishing SONIA on a daily basis, which is the risk-free rate, they publish the SONIA compound index, sort of their official compounding methodologies. You've got the same in the US with the Fed. Singapore has started doing that with SORA too. So these common methodologies are being kind of released, and really it's only been in the last few months that they've been released. And I think that will make a big change, because we even saw earlier in the year, everyone was sort of saying, well, I know I need to use these risk-free rates, but what's the methodology I'm supposed to use? What are the day counts I use? Which holiday calendar? That is slowly getting ironed out. The other thing I'll touch on actually is fallback rates. So that's another kind of major issue in this subject. And now, at least for the derivative markets, there are proper conventions to use for all the people who have LIBOR derivatives, which are basically set, which have exposure going out past 2021 and when LIBOR is supposed to end. So let's say if you have some kind of LIBOR, some swap with LIBOR in it, which is maturing in 2025, there is now a process, there's benchmarks and different rates you can use to manage that exposure. If you have existing derivatives which use LIBOR. So those are kind of global standards which are being accepted. So I think now we're in a quite good place in terms of what the messaging is. I think the problem is at the start of the year there was still a lot of uncertainty around what to do and exact like methodologies and conventions and so on. I think we're in quite a good place now where what you need to do is fairly clear. I think the next stage really is how do I do it, and how do I do it now in an increasingly short time frame. I don't know if you'd agree with that, Rebecca, also, and that's the kind of, if that's your view on the sort of state of play and progress around this whole issue too.
Yeah, we're certainly seeing our members at the financial institutions move from the planning stage into the implementation stage, right? I mean, it does come out with its fallbacks. We have the things, we understand, as you point out, what we need to do. And the question is now, how do we implement such a large project? How do we actually, identify all the contracts, identify all the systems, and make sure they're all remediated and are ready for the preparedness transition. So yeah, we're seeing that same thing. And, ASIFMA is really looking to support financial institutions, both its own members and, the community at large in this transition. We've put out a preparedness handbook on our website that can help you if you're an FI and you're just kind of embarking on your IBOR transition preparedness projects, that it can help you identify what to do and how to get ready, and give you sort of a checklist in terms of how to organize yourself and where to look for things that are going to be impacted by this transition. We are also starting to collect outstanding questions and better understanding the external frictions that the financial institutions are concerned about that really threaten their ability to be IBOR ready a year from now. So there's going to be a lot of work going on in terms of identification of IBOR related issues and then how to solve those issues, both from a customer handling perspective and there's going to be all sorts of collateral consequences in tax and systems and in terms of perhaps legislative reform. So all of these things are going to start to take off.
Thank you both. And I know at ASIFMA, you guys are working on a project related to conduct risk. And I think one of the questions from the audience was around how this can kind of be incorporated into the transition process.
Yeah, we're putting on panels in every country in Asia, panels that sort of go through what banks are doing to prepare for IBOR. And one of the topics obviously is conduct risk. And you're going to look, ASIFMA will hopefully be producing a handbook in a short period of time that relates to sort of helping people understand conduct risk. And that really means, how do you talk to your client and how do you get them to basically renegotiate paperwork that you have with them for a derivative or a bond or a loan agreement or perhaps another type of agreement. So how are you going to get them to the table? And this is going to be a big issue. There's a lot of concern in Asia in particular about IBOR readiness in terms of the marketplace. Do the counterparties to all these financial institutions or the smaller financial institutions really understand what's going on? Are they ready to sort of sit down, roll up their sleeves and, take care of all the documentation that at the end of the day is kind of the crux of the IBOR transition, right? There's two big milestones. It's deciding on the rates and then it's redocumenting all the paper. And it's a really big project. And we have to encourage people to do things like treat all clients the same way. You can't cherry pick the transactions that you want to do one way versus another. I mean, all the clients are going to have to be managed the same way, or you're going to run litigation exposure. How are you going to handle agreements with many parties, and you can't find all the parties? I mean, these are dealing with these issues, and this is called tough legacy. What are we going to do with all the contracts that we can't easily amend? How is this all going to play itself out? These are things that the market is really starting to worry about.
Thank you. And I'm aware that we are running out of time, but there are so many really interesting questions coming in. And I think this relates back to both of you talking about the focus on implementation and the various challenges associated with it. How do you see the transition having an impact on the markets before and after day one?
I think the biggest issue now, if I'll just take a field for a second, is that people aren't sure what to use. Should they use the old or the new? And they're really, clients still want the old. They're really not ready for the new. So how does a bank manage that when their clients really want LIBOR? They're not really ready to move to the alternative reference rate. So there is a bit of a struggle there, and getting everyone to sort of accept the fact that this is actually going to be the new world is going to be a huge transition and take a lot of client outreach and probably, go on through 2021.
Yeah, I think it's hard to think of when that day is going to happen, because I think I agree with Rebecca in terms of that confusion that'll be there. I mean, I think there could be some potential added confusion, because there's been a few, I don't know if it's hints, but or suggestions that even after LIBOR is deemed no longer representative, there is a suggestion that its calculation could continue for these tough legacy contracts to basically migrate off, which is basically a bit of a lifeline. The problem is that if you do that, it's obviously very, very risky, because you just don't want new products and so on using it. So there is the possibility that these small lifelines could be given, but if that's given by the different regulators and working groups, they're going to have to be extremely clear on when it could be used. And they are saying that's certainly not a get out of jail free card. It's certainly not something you can rely on. So I think, we'll see that. And obviously, I think by then we'll still have a lot more. There will be, I reckon, new RFRs by then. There'll be more conventions by then. I really think there is actually going to be a fairly quick, that we're sort of coming out of this confusion phase and going into this real sort of implementation phase now. So I actually think there will be this kind of consolidation and just kind of acceptance of it's the new way of pricing things once all the kind of technical difficulties are done. And I think more and more central banks will also follow examples of some of those which are kind of really pushing hard on this. The UK's been obviously pushing very hard, but that's just because of they're the supervisor of LIBOR. But even if you look here in Singapore, I think the MAS and the different working groups have done a pretty amazing job here to move people off SOR, which is our sort of main interest rate benchmark for derivatives, to SORA, which is the RFR. And there's a lot of working groups going on. They're making sure they're just really making sure that there's a lot of new SORA related transactions available. There's contributions for it. There's all kinds of data available. There's a lot of different sessions being conducted for corporates, for banks and so on how to use it. And even in Singapore, we've seen there was doubt on some of these markets, like the more simple markets I was mentioning, like loans and so on, which may not be able to use risk-free rates, and they would need these forward-looking rates. But actually in Singapore, we've already seen SORA-related loans offered by the big banks to corporates and so on. So actually, I think the message is that if there's strong enough kind of willpower, locally by the different associations and regulators and so on, and basically very strong messaging around the conventions, the best practices, things can actually move pretty quickly. I'm surprised at how quickly things have really happened here in Singapore, and hopefully that's a good sort of blueprint for other jurisdictions to follow.
I would just add on to that, what we're really seeing is a decoupling, right? We're seeing Singapore, Hong Kong, Sydney, Tokyo, doing a terrific job in getting out in front of this. Other countries, have yet to deal with IBOR with the energy that they're probably going to have to. We're getting very little out of China, for example, and how this is going to impact them. So, if you were to ask me the question of what's the biggest challenge that's going to be in Asia, it's the fact that I think we're going to have more of the unknown unknowns here. We are going to have more things that, are a little more complicated because they're multi-jurisdictional, they may be multi-language, they may be lots of parties, people disappear. It's, outside of the major centers, it's going to be a little bit rougher and bumpier. And, we really all have to focus, I think, in large organizations on making sure that all our branches across Asia have support And it's not just happening in Hong Kong and Singapore. One of the big things we were seeing at ASIFMA is that people were coming into our webinars and our programming from Hong Kong and Singapore, and not from, the other countries in Asia. So we've actually are going around now country by country, developing very bespoke programs to address individual needs in each jurisdiction. So, Asia is not going to be a uniform place as it comes to IBOR readiness.
Fair point, Rebecca. And I think that's always the case with regulatory reform in the region. And I promised I'm going to wrap up, but I just wanted to squeeze in one final question. And I think that goes back to how can perhaps financial institutions, the bigger ones, perhaps lead the way for smaller banks? Do you see that happening?
Yeah, I think there is also, there is quite a division between the big players and the smaller ones, which you would kind of expect. So I certainly see you're seeing the lead. I think what Rebecca mentioned is really wise, right? And we're not only seeing that the big banks only care about Singapore and Hong Kong. Usually those big global banks, they have a program which is sort of far-reaching to all their branches. The problem is the smaller ones who don't have those branches, and frankly, it could just be because they have less LIBOR exposure. They will have some though, which is the problem. But it happens if you're sitting in a smaller market, there may be less exposure, so you're less involved. There are some smaller markets. So if we take Thailand, for example, you would think maybe it's not a market that would think that much about LIBOR transition, but it happens that the main interest rate benchmark in Thailand uses LIBOR as an input, as does the one in Philippines and in India and Singapore also. But those things can also be major catalysts, because obviously if your main version of LIBOR that you have in your country is actually using LIBOR, which is due to discontinue, it's just inevitable. It just accelerates everything. Then the problem is there are the countries which need to be addressed. So I think, yeah, it's absolutely up to the big guys to lead it. What we've seen typically in the different working groups that there are in different countries, they usually do consist of the guys from the bigger banks who are on the working group. But I think what's nice to see is they're not, when you see them talking and doing all the sort of, talking about what they're doing, it's not really a sales pitch about how great their institution is. It's really kind of like, well, we all need to do this together. So I do see them kind of, they're definitely sort of leading the way, and they're not sort of just doing this in isolation, I think.
I would say you're highlighting exactly the big challenge Asia's facing, right? All the big banks are all over IBOR readiness. There's no doubt about that. They're doing customer communication, customer education. They're doing outreach. They're supporting ASIFMA very heavily in its outreach. The question is, what happens with that message once it gets beyond the big banks? And are the smaller and the local financial institutions, are they really approaching this with the rigor that they need to? And it's really time to start making sure that's the case, because the consultants, if we had one of these consulting firms on with us, what they would say is people underestimate their IBOR exposure generally. So they assume that their exposures may be limited. Maybe they have a couple of derivatives contracts they need to renegotiate. They don't really get it. And once they start to really embark on their IBOR journey, they're actually floored about the extent of their exposure. So to anybody out here in a smaller organization that's just starting that journey, please begin working on it and use the resources available at Refinitiv, at ASIFMA, at your counterparty institutions to sort of help you sort through this.
Okay, maybe just to wrap up, Phil, I guess you can address that final question about Refinitiv's plan, and I think also just to kind of give further resources for people to check out.
Sure, and I'll just be very quick. So, I mentioned our term rates already, which are Sonia, but for those who have specific pound sterling exposure, who need a forward-looking, robust rate. But what we also have is obviously a huge project to update all our sort of calculators on our terminals, on our Icon terminals. Everything, there's so many things which we're using, which again highlights the issue, right? There's so many things which are being calculated using LIBOR and other IBOR. So swap price calculators and options calculators, all these kind of things. So they're all being updated. So you can use not only LIBOR, but you can also use the risk-free rates. You can use compound methodology. So we're doing a lot on the sort of user interface side in terms of like analytics and tools. They're all being updated. Also think tools for, let's say if you're an asset manager who has these instruments in your portfolio, so basically conduct risk analysis and modeling and things like that for when you have to move off LIBOR and value them a different way. So all of that, and then, so that's one thing on our terminals, but in our actual market data and our feeds and reference data and things like that, we've got, new fallbacks are in there. We've got new like bond terminology, all the new sort of reference data, which goes around fixed income to do with LIBOR transition and fallbacks. That's also been incorporated. And then also all the new data sets. So we have all the new RFRs, but we have all the compound RFRs, which as soon as they become available, we've got the broker data sets for the OIS data, all the new data which is coming up. So there's a lot of more data, more and more, which is coming along, and we're obviously onboarding that too. So there's a lot going on, not only from the desktop perspective, but also our feeds. And obviously, as we're the biggest benchmark administrator in Asia and in other regions too, in interest rates. So we're working with a lot of central banks and associations about how to basically lift their benchmarks regimes out of the past and kind of modernize them. Like we're doing with, like we have in Singapore, where we're the calculating agent for the main benchmarks here. So that's keeping us very busy.
Thanks so much. And yeah, I guess the bottom line is that financial institutions have their work cut out for them. But Rebecca and Phil, thank you for joining us today and for all the helpful insights shared. I think from the number of questions we got, I mean, it's honestly top of mind for everyone. So again, thank you for sharing your insights. And I think for anyone who would like to find out more about the topic, we actually have an on-demand webinar around the same issue, navigating LIBOR transition. So if you scan the QR code on screen or click on the link in the chat, you get to the on-demand webinar as well. And as usual, thank you so much for tuning in, and I hope to see you soon. Bye.